Hey everybody, Kevin Shortell here once again with part 6 of the ongoing series, Coronavirus and How It's Affecting Real Estate Notes, and the lending business. And in this particular case, also home sales. So let's talk about what's going on in the regular real estate market, because this is going to affect note holders as well. If we get this perceived inventory of non-performing notes coming our way, we're going to be getting some of those notes. I think workouts is going to happen probably 80% of the time or more, but you may end up owning a property. And what's that going to look like? Are you going to be able to sell it? And if so, when? And are you going to be able to sell it at a good price? What's your play out on the exit strategy? So all these thoughts come into mind looking into the future. Now, in a previous video, I showed you this particular chart that talked about the Mortgage Credit Availability Index. And this is something that the Mortgage Bankers Association looks at as to how readily available credit is for buying real property. And as lending regulations get looser, then obviously more credit availability comes into play as well. For example, you can see after the crash of 2010, by 2012, things got really strict. And you might remember those days. Trying to get a loan was very, very difficult. And then as the economy started coming back, they gradually started loosening up the lending. And this is about the same time that non-banks came into play and really loosened things up. And they started going back to 520 credit scores, 0% down, 5% down types of loans. So more credit became available, which is all well and good in good times. But once again, we looked at those notes a year ago, if you've been following along with me, and I said, boy, these are the ones that went bad the first time something happened to the overall economy. Well, obviously, we had a tremendous event affect the overall economy. And as a result, you can see that lenders immediately tightened that up, immediately said, we are not doing those loans because nobody's going to buy them. There's not a market for anybody to buy the non-qualifying loans where the borrowers had low credit scores, and even jumbo loans on the other side. So we saw this drop of 20% in this index. And again, everybody who buys notes has lost an appetite for buying loans where the score is low. It's got a high loan to value ratio. They don't want those, which means they want to see more of a down payment from people. They're not looking at jumbo loans as much because they're putting a lot of money out on one particular deal, and real estate values could go down. They don't want to take that much risk. And of course, adjustable rate mortgages, they really don't do those anymore because Fannie and Freddie aren't buying those. So essentially, the non-qualified mortgages are out. Nobody's originating those right now. So the lending market has tied up considerably, but it's affecting real estate all over the place. If you're in the private note business, you've probably been investing in the so-called lower spectrum of real estate, which is going to be $125,000, $150,000 or less. And you haven't been speculating or investing in the higher end, the so-called jumbo market, where property values are more expensive. Well, this virus affected everybody, obviously, and all lenders and all note buyers are being more cautious. So these jumbo loans, these more expensive markets, they're going to be in trouble. They're going to start to see properties sit on the marketplace. Property values are going to go down as a lot of properties don't sell. Properties are going to come off the marketplace. It's going to happen because jumbo loans, and I know that picture is a little bit blurred, but I blew it up as large as I could for you. But the important thing is you can see the trajectory there. So this is that same index, the Mortgage Credit Availability Index, as it pertains only to the more expensive housings, which in most places $500,000 and up. But you go to places in San Francisco, New York, etc., and those cities it's 750,000 and more that we're looking at. But look at that tightening up. They are shying away from those loans. That's a big pullback on those easy credit days. But again, this doesn't appear on this particular aspect to be nearly as it was back in the early days, the early years of the last crash. So our lending practices in 2005 through 2007 were absolutely just Wild West. I mean, nobody was watching after anything. Basically, anybody, we always used to make the joke, liar loans, have a pulse loans, that sort of thing. That's literally what was going on, because if you compare that to what happened now with that 20% drop, you can see way on the right-hand side of your screen, we're nowhere near the credit availability index as we were back in June 2006. So that's been a good thing. They've tightened that up considerably once we had the crash and all the foreclosures. They've been around that baseline for this index, and it's been gradually going up since 2012, and now there's been a bit of a pullback. So on the credit availability side, again, that's not so bad from where we were before, but that's not the only thing, of course, that you have to look at, because we're also in this situation as of April 16th, these numbers are, we've got 22 million people that have filed for unemployment, and that's in 4 weeks. I mean, so that's crazy. In a month period of time, just over a month, we've had 22 million people, and we don't know when we're going back to work yet, right? We don't know when in my particular area, when the theme parks are going to open, when the restaurants are going to open, when the retail stores are going to open, when anything's going to open. And I'm sure you're in a similar circumstance there, where we have a lot of unemployment, but we also have businesses that are not getting their stimulus money, and they don't know if they're going to be able to open their doors. So we have to look at that too, to see what that's going to do for the ability of people to buy homes. So obviously it's going to have a dramatic impact on home sales. Real estate companies are worried. They're not moving any product right now. We did see a bump in April of sales simply because those were contracts, from March and February and such. But based upon reports from the National Association of Realtors and others, right now, exact home sale data for April, really all the way actually after the lockdown, so sometime in April now, not really available just yet. However, the National Association of Realtors does a home purchase sentiment index, and that thing has just plunged. I mean, people are not confident enough to buy a home right now, which makes sense. I mean, they want to conserve the cash that they have, certainly not put it down on a home when we could be facing a big recession, depression because of this pandemic. They did a survey to realtors, National Association of Realtors did, and that showed the response was 90% of realtors reported that there was a decline of interest in buying property right now. You can't even show properties right now, right? There's virtual showings in some areas. Others, you can have one person in the house with the agent at a time, kind of thing. So very difficult. Also, existing home sales are expected to plunge 34% in the second quarter. And again, that number is a little inflated because of those April sales that have come in as a result of contracts from February and March. So May sales could be extremely low. And if we continue on with this throughout the summer, this year for real estate sales is going to be extremely low, and that doesn't help get the economy going. Now, on the positive side, if you're in the real estate note business and we start buying up these non-performing notes, hopefully the people are still in the homes. We can get those notes reworking again, and that's going to be strategy number one. But if we do have to end up taking properties back where families leave their houses, they consolidate once again, which they did in 2010, family members moving back in, and they just say, we're tired of facing the prospect of foreclosure, we're out of here. Well, then we will be able to come in, get those properties back, hopefully through deed in lieu, and then sell them. And seller financing, once again, is going to be the key, because bank financing is going to get very difficult to get here. So we're in the right business at the right time. We just have to be able to navigate these waters a little bit here. It'll be great working with borrowers, buying performing notes right now, buying or brokering performing notes of people who need to cash out, because again, it doesn't have to be your cash. It's a great time to make fee income in the business. So we do have a lot of opportunities in the industry right now, but what's coming down the road is going to change everything, and stick with me and we'll be prepared for that. So it's been Kevin Shortell. I'll talk to you once again very soon.